Rents have just hit a new record high, making it even more difficult for the average person to afford a home to live in. Now, we've already seen housing affordability skyrocket over these past several months as far as home ownership is concerned, but as we're seeing these house prices decline nationwide, we're still continuing to see rents go up. Now, this is a serious problem as we're seeing more and more Americans forced to relocate in order to find affordable housing, and evictions are even starting to surge. So what exactly is going on with rents? What can you do about it, and what does the future look like for the rental housing market in the US? Well, that's exactly what I'm going to be talking about in today's video, but before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Rents have been going up across the board nationwide as we recently hit a new record high as far as nationwide rents go. Realtor.com recently reported that nationwide median rents were reported at $1,879 a month in the month of July. Now, although the nationwide median income currently sits at $67,500, according to Zillow, and this is as of 2019, so keep this in mind, but the national median income as far as renters are concerned only sits at $42,500. If you break that down, that comes out to $3,541 a month, which means that there's many people in America right now spending over half their income on rent. Now, you do need to take into account the wage inflation has definitely taken place over that period of time. I know even in the last 2 years alone, we've seen about 10% wage inflation, so maybe a little bit more including 2019, but overall, it still means that there's a lot of Americans that are paying well over what they should be for rent. Now, this is having a significant effect on millennials and Gen Zers because over 50% of them rent where they live. So as a result, the inflation numbers we're seeing are actually even worse for them than they are for the average American, with millennials coming in at over 11.6% inflation year over year. Gen Zers are coming in at 11.3%, and the average American is coming in at 8.5%. Now, in real life, it's actually worse than that because government statistics are very unreliable at best when it comes to figuring out rent. You see, according to the Bureau of Labor Statistics, as of July, we're seeing rents up over 5.8% year over year for the month of July. And I can tell you personally, as someone who owns rental property, as someone who constantly is talking with other real estate professionals, that that is simply not the case. And I can guarantee you that rents are not up nationwide 5.8%. It's definitely significantly higher than that. Now, on the other hand, you have Realtor.com that reports the rents are currently up over 12.3% year over year. So why is there a big discrepancy between what Realtor.com reports and what the Bureau of Labor Statistics reports? Well, the big reason is how the Bureau of Labor Statistics gathers its information. The way they gather their information is they simply call a random homeowner and ask them, if someone was to rent your home today, what would you rent it out for, unfurnished and without utilities? The reality is the average homeowner doesn't really have a good idea of what they could rent their home for because they don't have a real finger on the pulse. They're not landlords, they're not property managers, they're not real estate agents, and so naturally they end up getting way off base as to what the real numbers are, and so it skews the numbers to the point where you have 5.8% growth versus 12.3% growth, which is really the more accurate number. Now, inflation actually plays a pretty important role when it comes to the rental housing market, and it's actually already contributed to why we already have a small supply of rental housing. Now, that's obviously important because when there's less supply and more rental demand, like we've been seeing recently in this rental housing market, it naturally ends up pushing rents even higher. So how has inflation contributed to rental housing prices going up? Well, with inflation, the definition of inflation is really just inflated prices of goods and services. And that's exactly what we've been seeing as the cost of goods as far as development costs. If you're trying to build a building, you're going to need materials and you're going to need labor. So goods and services are needed to develop housing. Now, we've been seeing the development costs of new rental housing already going up significantly. Starting with material costs, we've been seeing things like concrete and steel going up. We've been seeing labor go up. We've talked about wage growth taking place, and the Federal Reserve has been hiking interest rates, which only makes it more expensive to borrow money. All of this contributes to higher price points and lower profit margins for these companies that are building these new developments, and that eventually gets passed on to the consumer, which is you and me, having to pay these higher rents. Now, in addition to that, inflation slows down the process of building houses as you start to see housing starts and housing permits experience more delays with problems with supply chain issues. You start to have labor shortages take place, and all of this ends up putting less supply onto the rental housing market with all the delays that are taking place. And with a shortage of supply, it ends up putting more upward pressure on rents. Now, if that's not enough to add pressure to rents growing, you also have the fact that many buyers are getting priced out of the housing market thanks to the combination of high house prices mixed with high mortgage rates, and so many people are finding it cheaper to rent than to own, despite the fact the rents have gone up so significantly. So as a result of this, we have these extremely high rents mixed with an overall high level of inflation that many Americans are experiencing right now, and so as a result, we're starting to see more people get behind on their rent. Now, according to the Census Bureau, out of about 44 million renters nationwide that we have, over 8.5 million people are currently behind on their rent, with over 3.8 million people saying they're either somewhat likely or very likely to be evicted from their house in the next couple months. Forbes also reported that over 2 out of 3 Americans are currently draining their savings just to be able to make ends meet thanks to these inflation levels. The problem is that wages have just simply not kept up with the inflation of rents over time, and there was actually a recent study that was done between the years of 1985 to 2020, and they saw that inflation of rents grew over 149%, whereas the wage inflation was only 35%. Now, as we know, it hasn't gotten much better since 2020 because we've seen about 25% growth from 2020 to today, whereas wage growth wise, we've only seen maybe about 10%. So what can you do to deal with this high rent environment? Well, I think an economist from Realtor.com made a very good point that you can actually expect to see more rent growth taking place in the urban areas versus the suburban areas, and I think a big reason for that is because a lot of people are starting to bring jobs back to the office from this remote working environment that we were previously in. So as we start to see these jobs come back to the city, you're going to start to see even more rent growth taking place close by. So looking for housing in the suburban areas could definitely provide you better relief up front and even potentially over the coming years. Secondly, now is the time to start getting smart with your money. You want to cut costs wherever you can. So you want to take a look at your last 60 days of bank statements and go through every expense and every line item on that statement to look for things like unnecessary subscriptions that you can cut, just any unnecessary costs that you can get rid of on a monthly basis. Eating in more versus dining out can make a huge difference to your monthly food bill. In addition to that, you can also look at things like buying non-brand foods whenever you go to the grocery store, or even shopping discount grocery stores such as like Aldi versus going to Ralph's or Vaughn's. Now, credit card debt, if you have any of that, you need to eliminate that immediately. And the big reason is first of all, credit cards carry very high interest rates. But secondly, the Federal Reserve is controlling interest rates and they plan to continue hiking interest rates, which means that if you currently have a balance on your credit card, you can expect that your interest rate is going to continue to go up, which means that your monthly expenses will also go up with it. Now, if you have any savings sitting around somewhere, one of the positive things of the Federal Reserve raising interest rates is it also ends up raising savings rates as well. So if you can find a good high yield savings account, as of right now, there's many that are offering close to 2% interest rates on your money, which if you just have money sitting around, it's better to earn something than nothing. Many of the major banks like Wells Fargo or Chase, you're going to get a very minimal amount like 0.01%. You want to look for banks like Ally Bank or Marcus Goldman Sachs, which actually I have a current account with Marcus Goldman Sachs, and I actually have a link below if you want to use that because you'll get access to a 1.7% high yield savings account. But if you sign up with my link, you actually get an extra 1% that puts you up to 2.7%. Now, I'm not paid by them in any way to advertise. I'm just simply telling you what I use for my high yield savings account, and as a result, you'll get 2.7% for the first 3 months. You also want to use this time to increase your income because not only do you want to lower your expenses, but if you can also increase your income, then you're really doubling that extra margin you can have on your monthly expenses. And so if rent is to go up a little bit more, you're going to be able to handle and weather that storm. So in order to increase your income, you want to focus on learning new skill sets that can make you even more invaluable to the job maybe you already have. Or the other thing is you can focus on building a side hustle, creating an extra source of income. If you study millionaires, you'll realize that many millionaires have multiple sources of income, and you can use that extra income to then start to do things like invest your money, which is the next thing you want to start looking to do as soon as possible. Now, I know that many of you may be in survival mode right now, so something like investing might seem like something you can do down the road, but as soon as you're able to, you really want to start getting in the game of investing, because that is the thing that can completely change your financial picture altogether. For me personally, it was real estate investing that completely changed my financial picture, and so that's what I highly recommend to everyone I talk to as far as personal finance goes, is get started in real estate investing as soon as possible, especially because what many people don't realize is you can have a source of income. You have that cash flow when you do real estate investing correctly, which means that you can increase your monthly income. It's almost like having that extra side hustle. Now, there's a big misconception with real estate investing that only the wealthy can do it. Well, I can tell you personally, I came from a lot of debt. I eliminated that debt and saved up my first $20,000 to $25,000 to purchase my first real estate investment, and that was a huge shift financially for my family and I, and it completely changed everything from that point forward. Now, of course, you could do stocks and cryptocurrency, but the reason why real estate investing is so amazing is because you can make money in 6 different ways. First, you can make money with cash flow. So cash flow is just basically the money you make beyond the monthly expenses of your rental property, and that's very possible to do even in today's real estate market. Secondly, you have principal pay down. That's just simply your tenant paying down the mortgage for you, which essentially builds your net worth over time. Third, you have appreciation, and that's one of the best ways to grow wealth in real estate. Is over time, real estate goes up. It's a finite investment real estate because there's a limited supply in terms of land. And so because of that, it has that intrinsic value that will continue to go up over time. Now, amplifying that is number 4, which is leverage. And because you have the ability to control, say, a $100,000 investment with just $20,000 out of pocket, that allows you to multiply your return on investment because you get the benefit of whatever a $100,000 investment grows to versus the $20,000 you invested. The 5th way you make money with real estate is tax benefits. You see, the IRS created a code tailor-made to the landlord because they want to incentivize more housing to come on the market. Of course, rents will be more affordable the more supply they can get on the market. So because of that, they've created a lot of write-offs for landlords, such as depreciation, interest deduction, and things of that nature that can make it so that you can end up paying no taxes on all the income you generate. And then finally, the 6th way is value add. When you get very good at real estate, you can start to identify below market deals, get instant equity the second you buy them, or find properties that need fixing up to where you can add value by simply fixing them up. So all of this is why over 90% of all millionaires are made investing in real estate. And the great thing is because you have that income, that monthly cash flow that comes through, it can weather an economic storm. If you start to have a housing market crash take place, you just hold on to the property and collect that monthly income regardless. So overall, I do think we're going to start to see rent growth slow down because at this point, people can just simply not afford the rents that are coming through. People are already maxing out the amount that they can pay towards rent. Some people paying over 50% of their income. That's just not sustainable. And when you pair that with the fact that we're likely to enter an economic recession soon and we'll start to see unemployment levels going up, all of that will contribute to more downward pressure on rents, slowing down the overall growth of rents nationwide. So with that said, I hope you guys enjoyed today's video, and if you did, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know your thoughts in the comments below if you have any thoughts or questions, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor, and if you enjoyed today's video, I'm going to highly recommend checking out one of these 2 videos over here. And with that said, I'll see you guys on the next one.